Entry and profit-taking framework. The entry and exit paradox. Both entering and exiting markets present significant psychological challenges. While constructing a profitable position requires courage to deploy capital amid uncertainty, realizing those profits demands the discipline to act against prevailing sentiment. This dual challenge persists regardless of experience level. The entry paradox manifests when investors hesitate to establish positions despite thorough analysis supporting their thesis. During downtrends, the fear of catching a falling knife creates paralysis, waiting for perfect confirmation that often arrives only after substantial moves have occurred. Conversely, during strong uptrends, the fear of missing out can drive impulsive entries at elevated prices, precisely when risk-reward ratios deteriorate. Similarly, consistent profit-taking eludes many investors across market cycles. This difficulty stems from the asymmetry between theoretical understanding and emotional execution. When assets appreciate substantially, the very emotional drivers that should trigger profit-taking, excitement, validation, and anticipation of further gains, often impede rational decision-making. These psychological barriers manifest in predictable patterns. During uptrends, the fear of selling too early and missing additional upside creates hesitation. During downtrends, hope for recovery produces similar inaction. We also observe the opposite problem where excessive anxiety can lead to premature exits during healthy consolidations. Without a systematic framework addressing both entry and exit decisions, investors typically default to emotional decision-making precisely when disciplined execution matters most. The result becomes a cyclical pattern of poorly timed entries followed by either holding positions too long or exiting promising positions prematurely. Breaking this cycle requires structured approaches to both sides of this investment equation. Entry strategies. Entry strategies determine your initial positioning and cost basis, often the most critical decision in the investment process. For the fixed allocation, an initial larger buy could be warranted for someone with unallocated cash but no current metals holdings. Otherwise, systematic accumulation typically proves most effective. Time-based dollar cost averaging, investing equal amounts at consistent intervals regardless of price, creates an emotionally sustainable approach for building these foundational holdings. Regularly allocating a fixed percentage of monthly income creates discipline while minimizing timing anxiety. The critical insight for fixed allocation entries involves minimizing psychological barriers rather than optimizing entry prices, as these assets' long-term insurance function significantly outweighs short-term price fluctuations. The semi-fixed allocation, in contrast, might benefit from a hybrid approach combining systematic accumulation with opportunistic entries. For example, for a $10,000 paper-silver position, you might establish multiple entries through a structured 60-40 approach. A 60% time-based component could involve 4 individual $1,500 buys on the first of each month. A 40% price-based component would involve up to 4 $1,000 buys on gradually lower price points, should they materialize within the period. The semi-fixed allocation's main focus is thesis-driven positioning, and this approach maintains consistency while systematically exploiting volatility without relying on subjective market timing. For the trading allocation, which typically focuses on shorter timeframes, entries might require specific trigger conditions combining elements such as price action, volume confirmation, volatility bands, and potentially sentiment indicators. Scale and approaches may prove effective for trading positions starting with an initial pilot position, perhaps 30 to 40% of your intended total, upon first confirmation. This will then be followed by incremental additions if the setup continues to develop favorably. This strategy reduces the psychological difficulty of full position entries while providing built-in confirmation as the move unfolds. Scaling in should be approached with structure and discipline, ideally adding during consolidations or orderly pullbacks, rather than reacting impulsively to accelerating price moves. As the position builds, the stop-loss level may also be adjusted to reflect the evolving average price and new technical structure, helping to protect growing capital at risk. Trading entries should always incorporate predetermined exit strategies before execution. By establishing both profit targets and invalidation points before entering positions, you remove emotional decision-making during the holding period. This predetermined framework, documented rather than merely contemplated, significantly improves execution consistency across market cycles. It's worth noting that individual traders can have wildly different strategies and approaches depending on time frame, individual set of skills, and preferences. For example, rather than scaling in, some will buy a full position right away, which is a perfectly valid approach with the right risk parameters applied. Profit-taking strategies. The fixed allocation typically doesn't engage with standard profit-taking strategies. As true wealth insurance designed for preservation rather than optimization, these assets remain largely exempt from routine selling decisions. However, extreme valuation scenarios may warrant partial rebalancing even within this foundation tier. Typically, these occasions would occur once a decade rather than once a year, and even then be reasonably moderate in magnitude. For the semi-fixed allocation, which focuses on longer-term structural positions aligned with fundamental investment theses, a conservative tiered approach proves most appropriate. Consider this simple theoretical example framework where you have a first reduction, 15% of the current position, when an asset appreciates 75% from your average entry. A second reduction, 20%, when the asset appreciates 125% from average entry. A third reduction, 25%, when the asset appreciates 200% from average entry. The remaining core position will be held until fundamental thesis changes or extreme valuation occurs. This graduated approach accomplishes several objectives simultaneously. It secures concrete profits at predetermined levels, reducing overall position risk while maintaining substantial exposure should the asset continue appreciating. The progressive increase in reduction size reflects the statistical reality that higher returns correlate with increasing correction probability. Of course, this outlined example is merely one framework. Ideal numbers will vary depending on type of asset and market environment. For the trading allocation, where timeframes compress and objectives differ from long-term holding, a more responsive framework applies. In a loose theoretical framework, here you could, for example, have a first position reduction, 25%, when the asset appreciates 30% from entry, and another position reduction, 35%, when the asset appreciates 60% from entry. Exit of the remaining position will be based on technical indicators or when the asset reaches predetermined price targets. Allocation-specific considerations. When reducing semi-fixed positions, the capital typically shifts to other semi-fixed assets with more favorable valuations rather than flowing to the trading allocation or converting entirely to cash. This disciplined reallocation not only improves risk-adjusted returns but also reduces cognitive fatigue and regret that often accompany discretionary shifts. The trading allocation operates with more compressed timeframes and higher turnover expectations. Here, profit-taking becomes much more responsive to technical factors, but can also be percentage-based to varying degree. The principle of predefinition remains crucial, establishing profit targets before position entry rather than improvising exit strategies after gains materialize. Automation significantly improves execution consistency for the trading allocation. Limit orders, which means buying or selling at a specified price, remove emotional barriers during market euphoria. While some flexibility remains appropriate for significant market developments, the default should prioritize systematic execution over reactive adjustment. For the semi-fixed allocation, where entries and profit-taking reflect more significant strategic decisions, automation may or may not prove suitable depending on individual preference. Handling losses, the counterpart to profit-taking. Loss management represents the essential counterpart to profit realization, with both components working together to preserve capital and compound returns over time. For the semi-fixed allocation, loss management centers on thesis invalidation rather than price movement alone. These positions represent structural conviction aligned with fundamental drivers, making short-term volatility an expected feature rather than exit trigger. The appropriate question isn't, has the price declined X%, but rather, has my fundamental thesis been invalidated? For thesis-driven positions, establish clear, objective criteria for invalidation during your initial analysis. These criteria create a decision framework independent of market psychology, significantly improving execution during periods of fear or uncertainty. Without predetermined invalidation parameters, emotion typically dominates decision-making during drawdowns. The trading allocation employs more responsive loss parameters aligned with its shorter time frame and different objectives. Rather than thesis invalidation, these positions often utilize some combination of percent-based stop losses and technical breakdown levels. The essential principle remains consistency, predetermined parameters established before position entry rather than reactive adjustments after declines begin. Practical implementation and conclusion. Implementing this framework requires several practical steps beyond theoretical understanding. First, document your specific implementation parameters, the exact percentage thresholds, position reduction sizes, and redistribution allocations that align with your risk tolerance and objectives. This written record serves as an essential commitment mechanism during emotional market periods. Consider leveraging modern tools for this documentation process. AI assistants can help structure your framework based on personalized inputs about your financial situation, experience level, risk tolerance, and time horizon. By describing specific circumstances, an AI can help organize your parameters into a coherent document that serves as your personalized playbook. This approach combines your unique investment goals with systematic structure, creating a tailored framework rather than a generic template. Second, establish a regular review process that evaluates both your framework parameters and execution consistency. This review, perhaps conducted once every 6 months, provides opportunities to refine your approach based on real-world results while identifying any execution gaps between intended and actual implementation. Third, consider maintaining a decision journal documenting entry and profit-taking executions and the reasoning behind them. This record creates a valuable feedback mechanism, allowing you to identify patterns in successful and unsuccessful decisions over time. The journal's primary value emerges through long-term pattern recognition rather than individual transaction analysis. Calendar-based reviews provide essential counterbalance to event-driven reactions. By evaluating your semi-fixed holdings at predetermined intervals regardless of market conditions, you create systematic opportunities to implement your predetermined framework without reactive pressure. Even small, imperfect attempts at the steps outlined here will significantly outperform purely emotional decision-making. You can create your own streamlined framework suited to your situation, skills, and preferences. A systematic entry and profit-taking framework ultimately transforms one of investing's greatest psychological challenges into a structured process. By replacing emotional reactions with predetermined parameters, you create a repeatable system that performs well across various market scenarios without requiring perfect timing.